Mihir Vora joins us. Mihir, good morning. Thank you for joining us. Uh, this market has made a stunning comeback, and the comeback has been led by small cap stocks, which the index is at an all-time high. Now, when the market correction started, the general view was that small caps are frothy, small caps have become Humpty Dumpty, move into large cap. But small cap space and mid cap stocks, they continue to surprise us. Why is that?
I think it's all about growth, Nikunj. The market has been following profit growth, and that's what it's rewarding, and that's what we are seeing. So, I mean, I'm not at all surprised given the outperformance of the small caps because that's where the earnings are. If you look at the downgrades in the stocks that we keep talking about, it's mostly about the Nifty, and Nifty has a lot of energy, oil and gas, metals. Maybe the large cap IT stocks also have not guided so well. So the Nifty 50, which is the benchmark that we keep looking at, frankly has a lot of global exposure, commodity exposure, which is not really there in the small caps, and that's where the earnings growth are. So if we really want to participate in India's growth story in the in the higher growth segments of the economy, then we have no choice but to look at mid caps and small caps, and I think that's what the market's changing.
So, what is different in, let's say, in the first half of this year and the second half of this year, Mir, is the orientation of the stocks. Banks have started making a comeback, IT has surprised us, but autos and to a large extent consumer or staples are taking a backseat. Do you think this trend is here to stay in the medium term, at least 6 to 12 months?
Maybe not 12 months, but at least in the near 3 to 6 months, it looks like, because we are seeing a trend where consumption is still a question mark, while there is some green shoots in some pockets. But overall, if you see the K-shaped nature of the consumption has continued. So we are yet to see a decisive pickup in the lower end consumption. And that's why you do see the markets focusing more on the premium consumption, etc. I think the other reason why the consumption theme is probably underperforming is that markets now expecting the government to get back onto its spending, which was lacking in the first half. If you look at the first half, the state governments as well as the central government capex has been actually flat to negative against the positive 10% plus growth which is expected. So if they are to meet the budget targets, then we should see a lot of activity in ordering in the government linked sectors like infrastructure, roads, defense, railways, etc. And we are seeing some indications of that. So some of the extra attention of the market is also pulled towards these segments because there is much more visibility. The reason why the government did not probably spend so much in the first half is mostly attributed to election-linked slowdown in decision-making at all levels. But now that we are past the main elections, the central government as well as a couple of key state elections, the government does seem to be getting back on the spending path. So we probably see a lot more action on that side.
Interesting. Mihir, so in the last few months of correction that played out, where is it that you added to in your funds?
So we continue to play more of the domestic theme. On the global theme, we are underweight. So basically, we don't have much exposure to metals, energy, oil and gas, those kind of names. Even IT, we are underweight on the large cap IT. We are stock picking on the mid cap IT, where the business models are more tilted towards some of the higher growth services, so to say. On the domestic segment, we continue to play on the premium consumption theme, the financials theme, especially the non-lenders. And the infrastructure, the government spending, basically the defense, railway, that back. We continue to play that. We are also quite significantly overweight on pharmaceuticals on more on a bottom up basis because we do see a lot of potential, new business models emerging, especially CDMO, etc. And plus, we also see a lot of action on the generic space where we do believe that probably the worst might be over, and we have a few smattering of pharma linked and chemical kind of stocks. So that's where we are overweight on.
We spoke a lot about defense and railways and everything which has got to do with government spending. But suddenly from a market standpoint, market's not far away from its all-time high. These stocks are way, way away from its all-time high. So is the party over in some of these stocks? While these companies may grow, but from the current juncture, do you think stocks may underperform?
No, as you rightly mentioned, they have probably there was a lot of euphoria built up 4 5 months ago, and from those levels, a lot of stocks have corrected, and that was also coinciding with the point that we discussed, which is that the government ordering actually came down. So there was a bit of a slowdown in ordering across segments, and the stocks had run up. So there was a good, reason for them to correct. But now the stock prices have corrected, and we do see pickup in government ordering. So probably now the risk return balance is a bit better than what it was 3 4 months ago.
Interesting. Mihir, most of your funds, and at least the large cap ones, do have a big exposure to financial services. In fact, that forms the largest quotient. But within that, where is it that you have taken concentrated bets, or is it more an across the board approach with private banks being at the top rung?
Certainly. So we were underweight on lenders till now. And that served us well, because we did see private sector banks as well as PSU banks underperform in the last few quarters. But now, with the rest of the market having run up, the risk return balance is probably tilting in favor of lenders again. So by the way, while we were underweight on the lenders, which is banks as well as NBFCs, we were quite overweight on the non-lenders, which is all the capital market linked plays like asset management, wealth management, broking, exchanges, the registrars, etc. So on the capital markets team, we were quite overweight, including broking. We were underweight on the lenders. But now I think while we continue to be positive on the capital marketplace, we will start adding to the lenders, which is what we are doing. So within lenders, we continue to prefer the private sector banks, especially some of the larger ones which have really underperformed and probably offer a good value versus growth equation. And PSU banks, we are sticking to one or two of the top names, not really going down the market cap curve in the PSU space.
Okay. Mirza, what should be the broad expectation from markets next year? Assuming that the earnings growth would be 8 to 12%, are we in for a 12 to 13% kind of a return for FY25?
On the large cap indices, yes, but as I said, let's not over focus on the large cap Nifty. There is a lot of action happening on the side counters, on the mid caps and small caps. That's where we can add a lot of value in terms of stock picking. So yes, while the Nifty earnings growth may be 8 to 12%, the mid cap and small cap index earnings growth is likely to be significantly higher. So my recommendation or my guess is that a more flexi cap strategy would be an appropriate way to go, rather than stick to just a large cap strategy.
Any new exciting themes? Market periodically keeps on getting one or two themes. Right now solar is in demand. 3 months ago it was it was nuclear which was in demand. Any new themes which could be sub themes for 2025?
For 2025, I think if the market really has to outperform or not outperform, our markets can't outperform themselves, but if the market has to really give good positive returns, then financials have, especially the lenders, bank and NBFCs have to perform well. So while it's not a new theme per se, it has underperformed for quite some time. And with now the worst of the liquidity tightness behind us, that can give us a fresh leg up to the market. So far, the market has been supported by a lot of other segments. But if the big one, which is financial lenders, kicks in, then that can be a really good news to the market.
Interesting you say that. And within small and mid cap Mihir, what is the preference like? Because the year started off with those fancy defense and railways names, but they were the first ones to actually clobber down in the market correction.
So now we are back to the same names again, right? That's what we discussed. Because as I said, there was a clear slowdown in government ordering. So there was valuation froth on one side and slowdown on the other side. So a good reason for the stocks to have corrected. But the structural long-term theme in defense does not change. I'm actually more positive on defense as a longer-term theme than railways. Railways maybe is a 5-year theme, maybe, but defense can be a much longer thing, because we are just beginning to scratch the surface in defense local production, defense exports. So that can really have a much longer runway, which is what we typically look at when we are talking about terminal value investing. So I think the defense space, a lot of action to go. Government spending, especially on roads and infra, will also continue, because as I said, we are still not very confident about consumption recovery, and the government is aware of this. RBI is also aware of this. So I think the road sector, the road builder sector, the construction sector linked to government spending, that should also continue. And valuations in the construction space are not really that expensive so far.
One simple point, which is that everyone is also of the view that Donald Trump 2.0 means less geopolitical issues. And there seems to be an early indication that there could be a truce at least between Russia and Ukraine, and Middle East also seems to be simmering down in terms of the geopolitical crisis. Now, why am I phrasing my next question or point like this is because if geopolitical tensions will de-accelerate or de-escalate, what happens to defense exports?
First of all, while Ukraine has been going on and on, we also had the Israel-Middle East crisis. Now we have Syria also unstable. So I think there is enough instability in the world happening, first of all. And the other thing is that, if you look at defense, local production is the key. And that is a given. So for the next 4 to 5 years, we can see growth coming from sheer indigenization. And then, of course, it will be aided to a greater extent by exports as we go forward. And frankly, we are really in the I would say first step out of 1,000 steps in defense exports. And as I said, while we talk about 20,000 crores exports that we did last year, which is maybe a couple of $1 billion, $2.5 billion. The global market for defense is $1 trillion of defense trade. So I mean we are nowhere close to the close to scratching the surface also in export. So I don't think we should be too worried about global demand in defense, because we are really talking about gaining market share rather than the market rather than waiting for the market to expand. The market is already there. I mean, if you look at our size in auto and auto anch, compared to what we were 30 years ago. That's the kind of growth that we can see in defense also.
Interesting. Mihir, always good to chat with you. Thank you so much for your time today.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.